Hello and welcome. This is Accounting 1001, your first in a series of 3 accounting classes. And I'm Kimberly Brody. I'm a CPA with a local practice, and I do tax returns and tax planning, uh, accounting, bookkeeping, and payroll for individuals, small businesses, and corporations. And I also teach accounting classes here at South. I'm going on my 3rd year now. I can't always access the South University email from home or from the office. So if you'd like to just go ahead and email me directly at kimb422@live.com. After class hours are by appointment if needed. You can also talk to me at breaks and just before and after class if you have a question. I also try to allow plenty of times for questions and feedback during the lecture as well. So there's a copy of our syllabus uploaded to the new Brightspace. We'll go over some of the key areas of the syllabus here in this slides. The text we'll be using is Financial Accounting: A Business Process Approach by Reimers. It's the 3rd edition. And you should have access to that through Brightspace in the electronic copy. The chapters we'll be covering in this first of your 3 courses rather. So during Accounting 1001, this course will be covering chapters 1 through 5 and chapter 9 in this book. And you'll be covering the remaining chapters in the next class, ACC 1002. In both classes, we're going to be using a companion site called My Accounting Lab a lot through the class. That's where all the quizzes and the homework will be completed, and the final exam as well. So as I mentioned, Accounting 1001 is the first of a 3-part series in accounting. So this first class is an introduction that covers the basics of financial accounting. And we'll expand on that in Accounting 1002 and then gradually transition you into managerial accounting for Accounting 1003. Your grade for the course is going to be broken down as follows. 15% of the grade is your homework assignments. 60% of your grade is your quizzes. Now that's a big chunk. So we're looking at these numbers, you can see right away you want to take your quizzes seriously. 10% of the grade is more subjective, participation in class. So, participating in the class discussion, raising your hand, answering questions, asking questions, just being present and paying attention. Then the remaining 15% of the grade is the final exam, which will be comprehensive, so it will cover all of the chapters that we covered in class. Now, I can't stress enough how important these quizzes are to your grade. That's 60%, that's more than half. You can't pass the class if you don't take the quizzes. But conversely, if you do take the quizzes, you have a very good chance of passing the class. And if you take your time to study and prepare for your quizzes, you have a really good chance of getting an A in this class. It's not impossible. I try to make it very attainable, and this is the way that I structure the classes and the course. So first we have a lecture, like we're beginning now, and then I send you home to do the homework for the chapter that we discussed in class. And then we go over that homework in the following class, and then you're ready to go home and do the quiz. And what I also suggest very strongly is that if you did not get 100% on your homework, study whatever you missed so that you learn it. And you know it really well when you go to take the quiz, which will be very similar to your homework, maybe not identical, hopefully not identical, but very similar to your homework. So if you understand the homework, you'll understand the quiz. If you didn't read the chapter, didn't listen to the lecture, and didn't do your homework, you not got such a great shot at the quiz. So read the chapter, attend the lecture, do the homework, then take your quiz. And take your quizzes on time. That's the only portion of the class that I'm a stickler for due dates, because we discussed the quizzes in class the following period. So it wouldn't be fair to the students that had taken the quiz if students that have not yet taken it are now getting all the answers in class and then going home and taking their quiz, or taking it during the class that we're discussing it. So of course we can't do that. So I do have to be a stickler with the dates, the due dates on the quizzes. If there is an emergency that you just can't help, just let me know. Like if somebody, if you're in the hospital, of course, I'm not going to say, I'm not going to hold you to a due date. Hopefully that doesn't happen to you. Just, oh, I had to work, or my favorite TV show's on, or I went to a birthday party. That's probably not going to get you an extension of the quiz. But of course, if it is a extreme emergency, then just reach out to me and we'll work something out. The grading scale is typical. 90 to 100 is an A, 89 to 80 is a B, 70 to 79 is a C, and we won't talk about anything below that because I don't want to see any of those. Academic integrity. I expect all of you and each of you to do your own work. If you want to talk about the homework with your colleagues and classmates, that's acceptable. But when it comes to quizzes and tests, I expect that you're doing that on your own. And we have due dates for the reasons that I mentioned, because we discuss it in class the next day. So you have to have it done before that. One, so that I'm not giving you all the answers, because I want you to actually learn it. And two, it's much more beneficial to you to be able to discuss the questions once you've already attempted them. Otherwise, it just sounds like blah, 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 and you'll probably fall asleep halfway through wondering what we're talking about. So it's really helpful to come to class prepared. To be able to participate in this discussion, you'll learn much more. That way, it'll be much more valuable to you. All right, so that is the end of our intro, and now we're going to jump right into discussing our first chapter. Chapter 1 of the Financial Accounting book. You'll notice here they have a picture of a t-shirt, Team Shirts, and then the chapter number. This is a pervasive theme throughout the book. You'll be hearing about a fictitious company called Team Shirts, and they'll use that company to illustrate many of the topics that they'll later discuss throughout the text. So chapter 1 is titled Business. What's it all about? After you have read, listened to our lecture, and done your homework, then you should be able to do all of the following. Describe what a business does and various ways a business can be organized. Classify business transactions as operating, investing, or financing activities, which we're not going to spend a lot of time on for Chapter 1 because we're going to go into this in great detail in Chapter 9. You'll be able to describe who uses accounting information and why accounting information is important to them. You'll also be able to identify the elements of the 4 basic financial statements, which are the income statement, the statement of stockholders' equity, the balance sheet, and the statement of cash flows. You'll also be able to explain the purpose of each of those financial statements and be able to use basic transaction analysis to prepare each statement. You'll look at the elements of a real company's financial statement and be able to identify what those elements are. The last learning objective, you'll also notice that this is a pattern in the text. Every chapter includes a segment about risks and ethics. In Chapter 1, they'll discuss the risks associated with being in business and the part that ethics plays in business. Each chapter also opens with an ethics matter, and this chapter is no exception. So, when or if you're asked to do something questionable, you should ask yourself, is what I'm being asked to do legal? If I do this, what I'm being asked, would it harm anyone? Would you want to read about this in the newspaper if you're doing what you have been asked to do and you carry this out? Is this something you would want publicized or kept hush hush? I guess Bernie Madoff was big in the news at the time this was published, so they chose that as an example. If he had asked himself these questions, would he have done things differently? I don't know, we probably all know who that is, but just in case that name's new to you, he's the biggest name people think of when they hear the word Ponzi scheme. So what he was doing was soliciting, marketing himself as an investor, and he would uh, take other people's money, which he was supposedly investing, and then he was paying other people, some of his clients, he'd be paying out amazing gains, much more than you would get from a money market or generally investing in the stock market yourself. So people thought, wow, this is a great return on my investment. And then they told their friends, and their friends gave them more money, and more people gave him money. But what he was actually doing was he wasn't actually investing any of those funds. He was giving a little bit of some of one person's money to the other person to make them happy and think they're getting a great return, when really he was just keeping it all in his bank account and not investing. And then he eventually just took everybody's money and ran. And he got caught. So had he asked himself, is it legal? His answer would have been no. Will it harm anyone? The answer would have been yes, tremendously. And would you mind reading about this decision in the morning newspaper? Probably he would not be proud. Probably his mommy would not be proud, or none of his family or friends. Uh, but I don't know that someone that his moral compass obviously wasn't pointing true north. So I don't know if he had asked himself those questions and answered them. If A, he would have answered them honestly, and B, had it would have changed what he did anyway. So hopefully, my students here are not of that frame of mind. If I guess the idea is it legal? If the answer is no, you could say, sorry, boss, I'm not going to do that. Will it harm anyone? If the answer is yes, you'll be like, sorry, no deal. And would you mind reading about your decision in the newspaper? If it's something you wouldn't want publicized, that you wouldn't want your friends and family to know, uh, hopefully you will reconsider doing that and think, maybe I shouldn't do that. Maybe that's not a great idea. So that's the basics of the point they're getting across here. Don't be a Bernie Madoff or anybody else who has done great harm. You could wind up like this. And we don't want that. Learning objective 1. The purpose of a business is to provide goods or service to make a profit. Steps to that include obtain capital. It's number 1. Just like the old saying, it takes money to make money. You got to have some money to invest into starting up the business. Then with that money you've obtained, you need to go out and buy the resources that you need to start and run your business. Then you have to take those resources to create something of value. Taking raw goods and creating a finished product from those materials, or using your computer and your printer and paper to prepare tax returns, like I do. And then you have to sell that product to customers. Because you could have these wonderful products sitting on a shelf, but it's not going to make you any money or keep your business going if all they do is sit there. They've got to actually be sold as well. A for-profit firm is anything other than a not-for-profit firm, which is also known as a nonprofit or a charity. The goal of a for-profit firm includes making profits for its investors. In a business school, you'll generally hear about that as the number one goal, although there are other considerations in a for-profit firm, since we're talking about ethics. Should that be the only goal, making money for investors? Well, hopefully their goal is also to provide society with a beneficial product or service, to provide employment opportunities, and to help the community. Those are also nice goals. But what distinguishes a for-profit from a not-for-profit is the profit motive. A not-for-profit or a charity can still take in more money than they actually spend, although they're not supposed to have a lot accumulated for no apparent reason. They're supposed to give the money that's donated to them to the causes that they are supporting. So here's a simple business model. Inputs, what you put into the business, would include cash from capital or financing. So capital meaning owners putting money into the company. Financing would be borrowing money. Property, plant, and equipment are the major buildings and machinery used in the business. Raw materials are the ingredients. The labor is the employees. Inventory is your finished goods sitting on the shelf waiting to be sold. The outputs would be taking all those ingredients and either producing a product or a service. The simple business model really is a bit simplified because not all of these inputs would be used in a service industry. Namely, raw materials and inventory would not be present. So a service company provides services for its customers, not a tangible good. For example, as a CPA, I provide a service to my clients. Even though I might hand them a copy of their tax return on a piece of paper, that piece of paper isn't actually what they're paying for. They paid for my time to put their information into the right boxes on that form and send it electronically off to the government agencies. They paid for my advice to help them make good business decisions. They paid for me to keep track of their business transactions and categorize and report them accurately so we could take that information and use it to obtain more financing, to file their tax returns, etc. So there's service, and then there's products, which they have here labeled as sales. And that would include merchandisers, which buys goods. A merchandiser buys goods already finished and then resells them to others, like a supermarket. A manufacturer buys ingredients or materials and makes products from those. Your Turn 101, 1-1. Whenever it says your turn, that's a question for discussion or a problem to work in class. But since this is a monologue, I'll just answer it for you. What is the main purpose of a business? As we discussed, the main purpose of a for-profit business is to make a profit, which is increasing the value of the company for its owners. What are the four general types of businesses? A service company, a merchandising company, a manufacturing company, or a financial services company. There's different ways to organize a business, different entity types. The simplest is a sole proprietorship. That's one business owner, not incorporated, just doing business as themselves. More than two-thirds of all U.S. businesses are sole proprietorships. That is a very grumpy looking sole proprietor. A partnership is two or more people working together in an organization, and they are not incorporated. Only about 2.5% of U.S. businesses are partnerships, and they earn less than 10% of all U.S. firms' profits. A corporation is a business whose ownership is divided into shares and may be owned by a large number of people. Or it may not be. You can actually have a corporation owned by one person. But what's significant about a corporation versus the first two types we discussed is a corporation is a separate legal entity from its owners. More than two-thirds of U.S. companies' profits are earned by corporations. Because corporations have the potential to grow bigger and therefore have greater earnings than one person working by themselves. So now we'll discuss some characteristics of these various forms of business, including personal liability, taxation, and transfer of ownership, and the ability to raise capital, as well as government regulations on those types of businesses. Since a sole proprietorship is one person working by themselves, that person is not separate from that person's business. Anything that that person does in their business, they're personally responsible and liable for. The income and expenses related to a person's sole proprietorship business are reported on that person's individual tax return on Schedule C. In order to acquire capital for a sole proprietorship, you have to rely on your own ability to generate money and to borrow money, or have gifts from family, or your own savings. So your opportunities for gathering capital, acquiring capital, are limited compared to some larger businesses. There's minimal government regulations on a sole proprietorship. You'd have to comply with the whatever business rules apply to your line of business and your locality. You may need a business license. You may need a various type of license from a local governing body for whatever type of business you're doing. For example, I need a CPA license from the state of South Carolina to work as a CPA in South Carolina and use my designation. Partnerships are like a sole proprietor but include two or more people. There's no upper limit to how many partners you can have in a partnership. Now, partners generally, there's forms of partnerships where this isn't true, but in a regular partnership, all the partners personally share the liability of the entire partnership. So if one partner messes up, all the partners pay for it. To help protect one partner from the mistakes or misdeeds of another, partners usually create an agreement that will describe how much work each will do and how the profits and losses will be divided, as well as the ownership interests and the liability interests, and any other details that they want to build in. The income of the partnership is reported. The income and expenses are initially reported on its own tax return, Form 1065, but the partnership generally doesn't pay income tax at the partnership level. That income and expenses are split up and reported to each partner on a Schedule K-1, which is then included on each partner's own tax return. A partnership, like a sole proprietor, is limited in its ability to acquire capital. They can get a bank loan, they can appeal to a venture capitalist, or use their own money. Excuse me. Partnerships, like a sole proprietorship, have minimal government regulations. Partners can basically agree to whatever terms that they want to agree to in their partnership agreement. So this differs from a corporation where they actually file a corporate charter with the state that they are incorporating in, and they have various other requirements. However, with a corporation, you have more ways to acquire capital because a corporation can sell shares of stock. So when they're selling a share of stock, they're selling a piece of ownership of that company for money. So they're getting money from a whole bunch of people. The owners of the corporation are separate legal entities from the corporation itself. So the deeds of the owners, the shareholders of the company, in most cases, are not personally liable for any mistakes or misdeeds of the corporation. Ownership interest in a corporation can be transferred more easily than an ownership interest in a partnership or a sole proprietorship. In forming a corporation, the corporation drafts a charter and files that with the state. And then the stockholders elect a board of directors. Being a separate legal entity means that the corporation can incur liabilities or debts in the corporation's own name. So when the corporation applies for a loan, it's not a loan going on the credit report of any of the individual owners unless they signed as guarantors. The corporation can be sued, and it can also sue others as if it was its own person. So if somebody's angry at the corporation and sues the corporation, it's not necessarily suing all its shareholders. In most cases, it's not. The corporation can enter into contracts. So the corporation agrees to buy 1,000 units of bolts from a hardware store. The corporation is obligated to make that purchase, but the shareholders are not. So if the corporation changes its mind and says, contract schmontract, I don't want to buy those, they're not going to come to the shareholders and say, hey, you got to buy all these bolts, because it's the corporation in that contract and not the shareholders. The corporation can own assets. So the corporation can own an office building and a manufacturing plant. It's not owned by the shareholders. There are other forms of business, in addition to those older kinds, that can have characteristics of both corporations and partnerships. They have the tax advantages of a partnership, which is the flow-through, meaning it's not taxed at the partnership level, but only at the individual level. And it has the limited liability of a corporation. And these hybrid forms of business are called LLPs, which is a limited liability partnership, or LLCs, a limited liability corporation. I prefer the latter, LLC. These business forms are mostly used by law, medical, and accounting professions. So let's test your memory from the previous slide. What are the three major forms of business ownership? Sole proprietorships, partnerships, and corporations. There are also LLPs and LLCs. From the owner's point of view, what are the advantages and disadvantages of each form of ownership? Sole proprietorships and partnerships don't have to worry about filing corporate charters. They control their own business. They're only taxed once, not at the company level, just at the individual level. Corporations have limited liability and the ability to raise capital from a lot of people by selling stock. Now the downside. Sole proprietorships and partnerships may incur liability and don't have the ability to sell stock as a corporation does. They can also have the corporations, although they enjoy the limited liability, they you're separated from your business as a shareholder. You put your money in and then management makes the decisions with it. Also, the corporation pays its own tax, and then as you receive dividends from the corporation, you pay tax on the dividends as well. As a shareholder who's just investing, that's usually not a problem from their perspective. But if it's a small corporation, maybe even a single person or just a handful of people, and they're working and they're putting their money into this corporation, it's taxed at the corporation level, and then they take money out of it, it's taxed again. That's called double taxation. I didn't mean to back up that far. Okay, fast forward again. Okay, I want to get back to this slide. So we talk about this business cycle here, but we'll get in later on. We'll get into how we record these transactions as they happen. So for now, we're moving ahead to learning objective 3, the information needs of decision makers. Revenues from sales, expenses incurred, net income, which is the difference between the income and the expenses, the inventory, and reliability of vendors are things you want to know to run the business, either as yourself, the sole proprietorship, or the partner, or as the manager of a corporation. You need to know how much money you're making, where you're spending it, what's left, how much inventory do you have on hand, are we getting, when we order our stuff from vendors, are we receiving what we ordered? Is it timely? Is the quality acceptable? Things like this. So the operating cycle. This is similar to the slide we saw earlier with team shirts. So you take your cash. You purchase your inventory. This is if you're a merchandiser. You make your sales to the customers. You get more cash. And then you keep going around. You buy more inventory. You sell more inventory. You make more money. And so on and so forth. So who needs accounting information? Turns out everybody needs accounting information. Management needs it. People with direct financial interests really want to know accounting information. They want to know how's their money doing. So those people with direct financial interests would include current or potential investors, current or potential creditors, and employees. Those with an indirect financial interest include the tax authorities like the IRS or the SC, Department of Revenue, regulatory agencies, economic planners, labor unions, financial advisors, etc. What are revenues and expenses? Revenue is income, but it's not any kind of money coming into the company. For example, when Sarah put in $5,000 of her own money, that's not income, that's capital. When Sarah borrowed $500 from her sister, that wasn't income, that wasn't revenue, that was a loan. So not all money getting deposited into the business checking account is income, but income is the money that's earned through operation of the business. The money that Sarah made selling those t-shirts, that would be income. The 4 basic financial statements, we mentioned this before. Those are the income statement, the balance sheet, the statement of stockholders' equity, and the statement of cash flows. And these names can be seen in many variations. If you pull up the financial statements of 5 different companies, you'll probably see 5 different names. Who sets the guidelines for accounting? Well, the Securities and Exchange Commission, the SEC, was created by the U.S. Congress to set the rules for corporations that trade on the public stock exchange. So these are extra rules for public corporations in addition to the rules that the accounting board has made. The SEC delegates much of the accounting standard setting responsibilities to the FASB, Financial Accounting Standards Board. SEC retains and sometimes exercises its right to set standards. The standards written by FASB, Financial Accounting Standards Board, are called Generally Accepted Accounting Principles, which you will very often see abbreviated as GAAP with a double A, GAAP. In more recent times, the SEC created the Sarbanes-Oxley Act in response to Enron and WorldCom's disasters. An agency created by the Sarbanes-Oxley Act is the Public Company Oversight Board, PCAOB. Their job is to audit the auditors who audit public companies to make sure they're doing things on the up and up. In addition to GAAP, which we use here in the US, many other companies are adopting the International Financial Reporting Standards. We are not yet adopting them here, and we don't seem to be very close to adopting them in the near future, because we have a few points of contention that we just can't get over. And I'm on the side of GAAP on these. We'll discuss that later. More in Chapter 11. That'll be in your next course. So in an overview, international guidelines for financial reporting used in many places around the world. That's IFRS. These standards are set by the International Accounting Standards Board, the IASB. And this is an older slide where it says the SEC plans implementation by 2014. That obviously did not happen and is no longer planning to be happen in any time in the near future because they could not agree on the treatment of revenue recognition or how assets are recorded and kept and maintained on the books. Also, compared to US GAAP, IFRS has far fewer standards and leaves a lot more up to judgment of the individual companies, which is opposite of where the US is trying to go to increase transparency and improve reliability of financial statements to restore investor confidence. That brings us to Objective 4, which discusses the 4 basic financial statements in further detail. The income statement is where you'll see revenues and expenses that during the period that the statement is reporting. So these happen over time. For example, income statement for 2016, calendar year 2016, is going to show all of the revenues and all of the expenses that that company incurred from January 1 through December 31, 2016. The net, so that's the revenues less the expenses, equals the net income. The balance sheet reports assets, liabilities, and equity accounts. The statement of cash flows reports in a different way. And when I tell you this now may not make more sense to you, but you'll see the difference as we go further through the course. The statement of cash flows is reported on a cash basis. It's basically like following the checkbook. Money in and money out. The statement of changes in owner's equities, it's even named 3 different ways within its own chapter slides. That is very similar to the equity section of the balance sheet, but rather than just showing the ending balance, it shows how did we get from last year's balance to this year's balance. The dates at the top of the financial statement are relevant. As I'd mentioned, the income statement shows you activity during a period of time, whereas the balance sheet shows you what was left in assets, what were the liabilities, and what was the net equity at the end of that period. So if we're talking about calendar year 2016, the balance sheet is going to be as of December 31, 2016. This is what we owned, this is what we owed, and this is the difference. The changes, like the income statement, the statement of stockholders' equity and the statement of cash flows also cover a period of time. The balance sheet is the oddball there. That is a snapshot in time. Assets are things of value that the company owns. Liabilities are something that the company owes to somebody else. It can either be money, like a loan, or it can be a service or a good that the company has been paid for but not yet provided to the customer. The equity is the owner's share of the net assets, the assets less the liability. And that can be broken down further into contributed capital, which is money the owners put into the company, and retained earnings, which is the earnings of the company, the net income from since the company was formed, accumulating in an account. So let's test our memory on our previous slide. What are the two parts of shareholders' equity? The two parts are contributed capital, money that the owners put into the company, and retained earnings, which is money that was accumulated through net income, which is the revenues less the expenses. What is a fiscal year? A fiscal year is any year that differs from a calendar year. So let's say the company's fiscal year they want to be June or July 1st of 2016 through June 30th of 2017. So it should be, roughly 365 days plus or minus. But it's anything other than January 1 to December 31, and there should be some kind of business reason for them to have an alternate ending date. This is a presentation I'd never seen before in my accounting, academic, or life or career. In my accounting classes and in practice, we write journal entries, debits, and credits. But in this book, this is what you're going to see, and you're going to see it in the accounting lab and in your text. They call this the accounting equation format. Rather than journal entries, which I'll show you in class examples of, they have you write transactions into columns that represent how they will be shown in the balance sheet. So they have you assets, liabilities, and capital, and retained earnings. And we'll show examples of that in class. The income statement describes the activity of a company during a period. Some of the other names you might see are statement of earnings, statement of operations, or profit and loss, or P&L. What's included in the income statement and what is included on the balance sheet? These are real important to know. This is very fundamental. The income statement includes revenues and expenses that happened over a period of time. The balance sheet, excuse me, on the other hand, shows you assets, liabilities, and expenses as of the end of that period. The statement of the changes in owner's equity, or statement of stockholders' equity, or statement of shareholders' equity, it's all the same thing. Starts with the beginning balance, which is the ending balance from the prior year. It shows any changes in the contributed capital or changes in retained earnings and how you got to the ending balance. That should tie to the balance sheet. The statement of cash flows includes the statement, the cash from operating activities, the cash from investing activities, and cash from financing activities. And we'll discuss that further in Chapter 9. How is the income statement related to the balance sheet? In other words, how does the amount of net income affect the balance sheet? The income statement shows you revenues and expenses for the period. The net amount, the revenue minus expenses, gives you net income. And that net income is added to the prior year's retained earnings to get the current year's ending retained earnings. And that is a balance sheet number. So you will see net income added to retained earnings in the balance sheet. You'll also see that appear in the statement of stockholders' equity, where it shows the difference in how you got to the ending balance of in the equity account. Why is it necessary to have an income statement and a statement of cash flows? Well, we'll get a better idea of the difference as we continue. The income statement is prepared on what's called the accrual basis, which means revenue is recorded when it's earned, and expenses are recorded when the good is received, or when the service is received, rather than when the bill's paid. So it's a timing difference, and that's why you need to see the cash flows too, because the cash flows follows the cash, when the money came in, when the money was spent, whereas the income statement does not, or may not. Learning Objective 5, Real Companies Financial Statements. A single step is the most simplistic form. It just has all revenues, then all expenses, then net income. Boom, done. What you'll generally see is a multi-step. There's going to be same info, but you're going to have subtotals throughout. So you got revenues minus your cost of goods. We'll give you your gross margin, or your gross profit. Then you have your selling and administrative expenses. And then you have other revenues and expenses, and you have your operating income and your income tax and your net income. So you'll see various subtotals sprinkled throughout that income statement if it's a multi-step, which is most commonly used. Like the multi-step income statement, there's also most commonly used what is called a classified balance sheet. So rather than just listing assets, we have our current assets, which are those we expect to convert into cash within a year. And then our long-term assets, which are property, plant, and equipment, and other assets. Liabilities are also split into current and long-term, current being due within a year, and long-term being due in more than a year. Shareholders' equity is divided into contributed capital and retained earnings, and sometimes other comprehensive income, but that's an advanced accounting topic. Our final objective for this chapter is Objective 6, Business Risks, Control, and Ethics. A risk is anything that exposes us to potential injury or loss. These are some of the risks in a business. Product failure. Someone's going to buy your product, take it home, and it's going to blow up in their face. Okay, that may be a little dramatic, but it might not work as it was intended, and they will be upset. Things can get stolen. You might buy something from a vendor who had a product failure, and it blew up in your face, or it just didn't function as it was advertised. There are strategic risks, operating risks, and financial risks. You may open up a store in a part of town that isn't interested in what you're selling over there, or doesn't get enough foot traffic, or is in a place where it's not convenient to stop. So maybe that's a strategic risk. Whoops, I picked a bad place. Operating risks are, your management might make bad decisions. Financial risks are you could lose money. Information risks, you could have information leaks. Every risk brings, an old cliche, every risk brings a potential reward. it's prudent to minimize risks. A manager should always put good ethical behavior above putting a good face on the firm's financial position or performance. In other words, don't fudge the financials to make the company look better. A control is something that's implemented to help ensure the integrity of the accounting records or the safety of the business assets. And that's it for Chapter 1. And I look forward to seeing you all in person on Monday, and we'll be picking up where we left off.